Morning, everybody. I'm Charting Man Dan with the Chart Guys. I'm filling in for Lori this week, but just a heads up, this will be our only pre-game show this week. Otherwise, the next few days, I'm going to be starting pre-game prep at 9 a.m. with Chart Guys members, but wanted to check in with you all and do a little bigger picture, zoomed out approach to the week as opposed to looking at today's action, at least initially. Obviously, we know the FOMC on Wednesday is going to be the event of the week, and just want to talk about leading up into that, game plans centered around that, etc. So thanks for all tuning in. Hope you had a great weekend. So FOMC Wednesday, 2 p.m. Eastern. The recent FOMCs that we have seen, the reactions that we have seen, the market has known what to expect heading into it. Just in the sense that, okay, we're not going to get rate hikes and we're not going to get rate cuts. And so essentially 2 p.m. rolls around, and we get the statement from the Fed, yeah, neither of those things happen. The market says, yeah, we knew that. The market doesn't react much. And then 2:30 rolls around and Powell begins his conference. And that's when we see a bit of an uptick in volatility, because that's where the new information is. Powell's statements, what's his tone? What's the forward-looking statements like? How does that shift probabilities of the future so that the market can price that in? This FOMC reaction is going to be very different because the market does not know what to expect. And again, whenever I want to know probabilities, I just Google FOMC probabilities, and you click the CME group link here, the top one, and it tells us, oh, it shifted pretty notably since I last looked. It's been volatile. We had, so here we got 65% versus 35% in terms of expectations, and it has been 50-50 more recently. So my point is, the closer you are to 50-50, the more a lot of people are going to be wrong. When you're 90-10 on what's going to happen, 90% of the market positions a certain way, that scenario plays out. Not a ton of repositioning has to take place. If you're 60-40, 50-50, and certainly expecting this to change over the next 2 days or so before Wednesday, but the more 50-50 you are, the more volatility you anticipate. And you're seeing that in some of the weekly options. If you're an options trader and you're looking at the implied volatility, someone in the Chart Guys room posting that this morning and pointing that out certainly makes sense. And again, we're going to get information at 2 p.m. We're going to anticipate more 2 p.m. volatility than we usually see on the FOMC reactions. And we're going to anticipate that a good chunk of the market that is positioning in the short term for either 25 or 50 basis points is going to be wrong. And so they're going to have to reposition. And that's where the volatility comes from. Now, in terms of the fundamental aspect, what do I think 25 versus 50 means on the whole? Well, how's the market going to react in that way? Honestly, that doesn't matter as much to me. And this may be crazy, but I never listened to Powell's statements during the FOMC. And honestly, the first 3-5 minutes, 2 to 2:05 p.m., I don't even look at the number. I look at the price. I have the 1 minute chart up, and I'm looking at the high of the day and the low of the day, and I'm watching the reaction to those prices. And that's all that I care about in that moment. A lot of people, with a more fundamental bias, or I should say, a skewed fundamental bias with their trading, are going to look at the number first and then make their decisions on what to do. I look at the price action first and make my decisions, and then I look at the number and get the information from there. But, as far as what's it going to mean, the narrative that I'm picking up just from observing others that care more about the fundamental aspect of it is that if it's a 50 basis point hike, that might show that the Fed is a little bit extra concerned about heading towards a recession. So maybe probability of a recession will increase if the Fed feels it is necessary to see a 50 basis point hike from the get-go, as opposed to, a few 25 basis point hikes. But again, that's just a narrative, and narratives often are applied to price action to try and explain it, when, again, all I care about is that price action. All right. So the preparations that we need to make here into the FOMC is, number one, we need a game plan for both directions. We need a game plan for a bull reaction and a bear reaction. And we have to keep in mind that there's essentially two reactions as far as I'm concerned. The first reaction is the reaction in the last 2 hours of trading on Wednesday, where, we get the info at 2 p.m., Powell speaks at 2:30. Next thing you know, the market's getting ready to close. There's not a ton of time for significant capital to be positioning in that 2-hour window, especially if they're responding to Powell's conference and his words. So oftentimes in the past, we have seen a reaction in one direction on Wednesday, and then Thursday and Friday, when you got full trading days and plenty of time to maneuver, an opposite reaction. And so one thing that I often say is, the real reaction is the following couple of days, not the initial knee-jerk reactions to those numbers. So just aware that, it can go one day on Wednesday and then the opposite way on Thursday and Friday, and being prepared for that. But essentially the two scenarios that we need to have are these tightening weekly ranges from the last 2 months break bull on the FOMC reaction, and they break bear on the FOMC reaction. And you absolutely need a game plan for those two scenarios, because the last thing you want to do is say, I'm pretty sure we're breaking bull. That doesn't happen. And now you're scrambling to try and form a game plan in the heat of the moment when emotions are high, when volume and volatility is high. And we know that's the last place that we want to be formulating a game plan. We want to just be unemotionally enacting our game plan. Support broke. Okay, I do this and this and this. And it's written down right next to my computer. I just read it and I execute the steps that are already enacted, or I should say already laid out. So we know the S&P 500 is stronger than the NASDAQ, and it's knocking on the door of all-time highs, but there are very clear short-term resistances in play right now for both the NASDAQ and the S&P 500. So leading up into the FOMC the next few days, I wouldn't be surprised to see daily consolidation take place in a number of names, and it's already looking like that's taking place. Here we have pre-market Apple weakness on pre-order numbers. So just checking in on Apple real quick. Daily time frame, another lower high is now set in this sideways range, and we can see the key support in the short term is being tested. Look at all these holds of 216, 217. 1, 2, 3, 4, essentially 5 times in the last week plus, we've held this zone. And we're testing it again in hourly oversold conditions and pretty beat up. So if I'm an aggressive bull, this is a bottom fishing play. I definitely would want to give a little wiggle room, but I'm not going to be trading Apple today, but I'm going to be watching how does it respond to this support zone, knowing the implications that it's going to have on the NASDAQ as a whole. We also have NVDA after a daily inside bar. We know it was a lead bull last week, but an inside bar on Friday, that's trying to break bear into daily consolidation. And again, that wouldn't be surprising at all. We just went straight up 20% in a week. And so we know daily consolidation will be inevitable. And the next bit of information that I'm looking for, which could be given to us pre-FOMC, is what is the response to first hourly oversold conditions from here on SPY, on QQQ, on NVDA. And we know that's the back burner trade setup, but I wouldn't call this a back burner because it's not the criteria. A sideways tightening range is not when you look for back burners. You look for back burners in breakout or breakdown strong trending markets. But that doesn't mean it can't give us information. Meaning, coming off the October low in the broader market, what feels like forever ago, I guess that was almost a year. Coming off this October low, they were not back burner setups. No, this most recent one, 2023. These were not back burner setups because we're coming off of monthly consolidation, but they were acting as back burners. Hourly oversold, marking daily higher lows. We just consistently kept seeing, one of my observations was we're trading as if we're in blue sky breakout right now, and we're not. That's showing us a significant amount of strength. So even if I'm not, high conviction playing a back burner oversold bounce, I can still observe the criteria and get information. So, NVDA, I may not play the hourly oversold bounce the next time we see it. I have no idea. It depends on when it happens and all that. But I will get information regardless of whether I trade it. Observing it will give me information. Does hourly oversold mark a daily high or low into continuation? If it does, that's best case for bulls. That shows strong dip buying and follow through. And if it doesn't, then that would increase the probabilities that a weekly lower high is potentially shaping up for continued tightening. That's a third possibility on some of these names. So FOMC, I just said bull break or bear break. Well, it is possible that, if we get a bearish reaction, but it's not massive, that we do just keep tightening up into end of September, start of October with some of these tightening ranges like NVDA, because there is so much range to still play within within this pattern. But again, overall, the S&P 500, if we're going to break bull, the S&P 500 will very likely do it first because of the proximity to the all-time highs and because of the rotation. We've been seeing, even right now, pre-market, Apple's dragging things down, as is NVDA. So QQQ is down $2 from the close on Friday. SPY's down 30 cents from the close on Friday. Why? Because as Apple is trying to gap down here, you've got XLF trying to gap up, XLV trying to gap up, and IWM trying to gap up. IWM's giving it back. It's now at the high of Friday. But again, that's that inverse relationship. QQQ is down. XLF and XLV are up, trying to offset it. They're not fully offsetting it. But again, I put out that quick video a couple weeks ago saying the first 15 minutes of every morning, I'm just watching what is QQQ doing and how does it relate to XLF and XLV. Are they all going up? Are they all dropping? Those are more rare. Or are they doing the more standard inverse to each other first thing? And so when the bell rings today, the first thing I'm going to be looking at is, can QQQ get a bounce going to hold the low of Friday in the short term? And if it does that lead to a pullback in XLF and XLV on their gap up opens? And they're not massive gap ups. They're just little ones at this point. But again, it definitely stands out. If QQQ is down $2 plus, those little names, or I should say XLF, XLV, trying to see small gap up opens. So all that said, game plan, let's get a little bit more specific. So I have a bull lean in my positioning right now. I still have some hedges, remaining partial hedges. Well, I don't want to get there just yet. First, let's talk about our short-term resistance. So we've got very clear short-term resistance in both the S&P 500 and the NASDAQ, which increases probabilities that we can very easily see some daily consolidation pre-FOMC. Here's this wall on the S&P 500, which is at the all-time high, and we're pulling back from just under that level. And the NASDAQ, remember on the way down, this quadruple top here, before things got ugly 2 weeks ago, we had a rejection, 3, 4 rejections, and then it got ugly. And so here we are at that resistance, and we're a bit extended. We just went straight up, 5-6% in 3 days to get to this resistance. So again, it won't be surprising at all to see this daily consolidation take place. And so my positioning, my mindset has been, I grabbed some hedge position a little bit early on this bounce as it was getting extended. And then I exited a bit into the drop. And now I have positions where I'm either going to stop out or I'm holding them a bit longer term. And so my stop is above the weekly lower high in the NASDAQ and the all-time high in the S&P 500. And that's partial protection for my long IRA, but I'm not fully hedged. So if the market drops, my IRA drops a bit. Not as extreme because, again, I've got those partial hedges on. But if the market goes up, my IRA goes up. And so I have a bull lean in my IRA, and the reason for that is because the bears are not proving to me on the weekly longer-term time frame that they're taking control. If these tightening ranges break bear, then I take a step back and reassess and say, okay, this is new information. The bears are proving something to me on the weekly time frame, and I better pay extra attention now. So the lows of 2 weeks ago is now the most important support level for me, into Q4 2023. No, 2024. So into Q4, that's the most important level for me now. And I will stay with a long lean as long as that is support. Why? Because the trend is bullish. The S&P 500 is knocking on the door of the all-time high. I'm not trying to nail tops in a bull market. That's not a good strategy, in my opinion. You could be scaling out into strength if you want, but trying to short or trying to nail the top is not a high probability long-term successful strategy, in my opinion. So I know that I'm not going to nail the top, and when I get a longer-term signal, I'll shift, and that'll be just fine because the majority of my trading is just getting the meat of the move in the middle and not nailing tops and bottoms. It's always nice when that happens, but I'm certainly not trying to do it on every move. And so that being said, I've got a bull lean. So what does that mean leading into the FOMC? I have a bear lean in my short-term trading to start this week because I'm trying to put myself in a position where I have risk-free shorts. Let's just say, the NASDAQ, let's say we hold the low of Friday first thing or break it with no follow through and then get a bit of an hourly bounce going into midday today or afternoon, whatever. I'm going to be looking for bear entries and bear trades today and Tuesday, Wednesday. Why? Because if I can position myself, I short the NASDAQ, I sell a little bit. I have a day trade sides position. I sell a little bit. If the hourly lower high gets set and it starts to go my way, and then I just stick a break even stop. And maybe we get to a scenario where FOMC rolls around and I'm still in that position because we pulled back for 2 days to start this week. And if it's a bull reaction, shoots up, knocks me out of my protection, break even. And if it shoots down, I'm now more protected. So when I say, and this context is so important because, if you're just listening to my preparation for today without knowing that context, and I say I'm looking bearish because of my bigger picture positioning. And maybe that wouldn't be the case, probably wouldn't be the case. If I'm flat right now and 100% cash and have no positions, then I'm probably looking for hourly oversold bounces for daily higher lows, just because the bulls did do some proving, specifically in NVDA and a bunch of these names last week. And a daily higher low is the most likely scenario on a ton of these names. So I would probably, again, if I'm only flat, I'm scouting daily higher lows to be the result of this consolidation. So again, that context is so important. And that's why, when I'm maneuvering my hedges and things like that, I always have to specify this is a hedge position. I wouldn't even be looking short right now if I was not trying to protect a very long IRA portfolio. So that's always important to communicate. But that's where I stand this week. I have a short-term bear lean to try and get a little bit more protection on into the FOMC. And then we'll see how the FOMC reaction goes from there. But as far as I'm concerned, weekly chart burden is on bears. S&P 500 would likely break first. Let's go. The most volatile reactions to the FOMC are likely going to be in the dollar, and the dollar's trying to be a weekly bear flag. If you're bullish metals, crypto, stocks, you'd like to see the dollar be a weekly bear flag and hit fresh lows. But again, it wouldn't be surprising to remain sideways until the FOMC here. We just pretty much had a double top. Now we're back to support after a double bottom, so sideways range. But in addition to that, we know the volatility is likely going to be in the low caps. IWM, it too has a real nice equilibrium here on the weekly. And again, we've had big drops along the way. Here's a big drop, but there's your big bounce, and we never confirm a downtrend. Big drop, big bounce, haven't confirmed a downtrend. That has to change. But IWM, this summer, it seems all of IWM's meaningful moves are based on fundamental data reactions. CPI, previous FOMCs, it's almost like that spark is needed to get an influx in trading that gives it volatility to break. Most of the time it's not doing much different than what everything else is doing, but you get the data reactions and then it is doing something significantly different. But I'm anticipating that IWM is going to have a significant amount of volatility, and also XBI, which is certainly more correlated to IWM, but I really like this wall of resistance here just because of how clear it is. Look at all these tops in XBI, 102s to 103s, weekly inside bar last week. We're getting real tight. If it's a bear reaction to the FOMC, this uptrend support line is going to be broken. If it's a bull reaction, we're going to break a triple top and get to the highest levels in over 2.5 years. That's a significant period of time. So anticipating XBI, IWM to have some of the more significant volatility. We know the metals have been very bullish. Gold's hitting all-time highs, so bulls are comfortable in the metals heading into the FOMC, knowing that even if it is a bear reaction, that we're just going to look for, a weekly higher low attempt, which has been, those weekly higher lows have been forming for months at this point. But that is where we stand. That is where I stand, and that is what we're looking for here into Wednesday. So again, initial reaction Wednesday, and then I need to post here in our chat room real quick, but initial reaction on Wednesday, and then meaningful reaction Thursday, Friday, which can be in a different direction. And of course, if we get a fake out, that's the least ideal scenario where, we break resistance on Wednesday, but then Thursday, Friday, we dump hard and break support. That's when it's much more difficult to trade. And so obviously we have to have some kind of game plan centered around that as well. We can't just say, oh, we broke bull, we're home free. But hopefully things stay nice and clear 1 second, and then we'll wrap up here. All right, one more thing I wanted to say was just an observation. I'm talking a lot more with friends recently, and I'm obviously not a financial advisor, but for friends that don't have massive net worths and aren't going to pay for a financial advisor, I know enough about markets to give them useful insight. And I've been having more and more of these conversations with friends recently, just friends looking to get into the market, friends who have a significant amount of capital and they're trying to position. And just I'm just giving some observations where just how different mindsets work. And it's becoming more clear. For me, 14 years in, I just get so used to being so comfortable being in and out, 10 decisions a day, money moving here, rotating over here, shifting to this account. It's just second nature at this point, and I don't even think twice about it. But I'm just noticing in these people how difficult decisions are financially because they don't have the confidence, obviously. So, lack of education, lack of experience equals lack of confidence. And so not having that confidence, it's almost like, once they make a decision, they want that to be the decision. And man, I don't want to have to make that decision again anytime soon. And so it's almost like, I go to cash and tomorrow that can be different. But for these individuals, if you sell some position and go to cash to be a little bit more protective in euphoria or whatever, it's almost like, well, then what do I do with that cash? Then I have to make a decision further down in the future. And it's almost like putting off that decision. It just was a realization to me like, oh man, this is why most people, just make one decision and then stick with it, which either leads to bag holding or leads to whatever, because it's this avoidance of wanting to make a difficult decision that you don't have any confidence in. And so, people that have a bunch of cash, should I put it in the market now? Well, my answer is things are still just fine. But, if you put it in here and then 2 months later, we're getting signs of a longer term top, are you going to be able to sell it in 2 months? Or are you putting it in and you don't want to think about it for 3 years from now? And so that for me was just an eye opener in terms of how different our brains are wired in these decision-making processes. And it really just all boils down to education, because without the education, you can't be confident. And it's almost like, man, just practice buying and selling one share of your long-term positions or things like that to just get used to it, to click some buttons and just get used to actually taking some action. All right. I appreciate all you watching. Sorry I couldn't interact with the chat a whole lot, but appreciate the supports and the likes and all that. I'll be doing the end of the day videos over the next bunch of days here, so I'll see you all there. And I'm heading off to live stream with the chart guys and get ready for today's trading action. Do good things. Have a great Monday.